But when we talked, gold was, at the New Orleans conference, gold was actually experiencing some pretty significant declines, but everybody seemed to be kind of accepting of that fact and comfortable that in the end, over the longer term, that we were going to have much higher gold prices, and those levels represented really bargain levels that were going to be turned around eventually, and probably by the end of the year to start a more of a seasonal rally. We talked at the time about the rising cost of servicing the federal debt. I don't remember if the latest numbers had come out then. I don't think they did. I think shortly after we talked, they came out. And at the time that we talked, they were about $600 billion a year annual run rate on interest on the federal debt. The next update came out shortly thereafter, and it's at $736 billion. And I was predicting at the time that it would surely be over $1 trillion very shortly because of simple math. At the time we were talking about a 10-year yield, treasury yield around 4% or so. It's dropped a bit since then. But I had done some work to calculate the actual interest costs on the federal debt over decades, and it seemed to come in around kind of like a smooth 10-year yield rate. So if you're talking about 3.5% to 4% on a $31 trillion debt, you're talking about $1 trillion a year. Well, now, as you mentioned, they're talking about 5% on the Fed funds rate, which would mean the 10 years is going to start hovering around that at some point. So roughly speaking, 5% on the federal debt is $1.5 trillion a year. So, the government has once again made me seem like a Pollyanna and an optimist. And they're spending more and more quickly than even I could have guessed. So that factor really has not entered the mainstream as I would have expected it to yet. I haven't heard anyone in the mainstream media talk about that huge cost of servicing the debt yet they keep talking about 5% now on the federal funds rate, and nobody goes to the next step and makes the next logical conclusion. What does that mean for debt service costs? When we were talking, we were also going into or getting ready to enter a seasonally positive market or period for the metals. Typically, gold starts rising or bottoms somewhere in mid-December. Doesn't always work out that way, but the majority of the time, it actually bottoms sometime around mid-December and starts a rally that begins or carries through into the new year. Gold actually bottomed right around early November and started that rally early this time around. And up until today, when we're talking, when gold's down about $25 or so, it has had a pretty uninterrupted move higher. And nobody's really recognized that fact. There's still a lot of doom and gloom in the junior mining space and among gold bugs. And nobody's really noticed that we put close to $200 behind us in the gold price over that period. And it looks pretty good going forward because the market, or the gold market at least, is beginning to sniff out the inevitable end of the Fed rate hike cycle. And all it will take at this point, in my view, is the Fed to pause, not pivot and start cutting rates, but just stop to really launch a kind of a massive move higher in the metals.
No, absolutely. I'm here with you, and we'll get into the details of why we're in a bull market rally. It feels like, or at least in an uptrend on the gold, but also on the stock side. You've been following the Fed obviously quite closely. Have you noticed a bit of a change in language? It's like I read the FOMC minutes yesterday, and they're really worried about a recession as well. So they're quite cautious. What are you hearing, and what are you making of this?
Yeah, it seems likely that a recession is on the way. I mean, you have the very steep inversion of the 2-10 Treasury yields, which has over the past 40 years or so has never failed to predict a recession. You have the collapse in the leading economic indicators, which over that same time period has never failed to predict a recession. So two of the most reliable indicators are pointing toward a recession. the thing that most of the mainstream economists and Keynesians are pointing to is the relatively strong jobs market. And now that argues against a recession, but my argument now is not so much that we're having a down jobs market. It's not really a lack of jobs. It's a lack of filled jobs. It's a lack, not of jobs, but a lack of employees that is really holding the economy back, which is unusual and maybe the first ever that we've been in this situation. People just don't want to work for whatever reasons. They've been trained, really, like Pavlov's dog, to sit back and not go to work, and they kind of got used to it over COVID. So for whatever reasons, there's a lot of unfilled job openings out there, and a lot of people sitting on their couches. So that is really holding the economy back. All the technical indicators are pointing toward recession. And that's why the Fed has started talking about, or very obviously talked about, slowing down the pace of rate hikes, not pausing the rate hikes yet, but slowing down the pace. And that alone was enough to really spur a rebound in all of the risk markets, stocks, bonds, and commodities.